welcome to the Deep Dive. Today, we're taking a close look at Parkin. They're the main player for parking solutions here in Dubai.
That's right. We've got their latest financial reports, operational updates. Basically, we're digging into how the business really works.
Yeah, and our goal here is to pull out the key insights, especially for, retail and institutional investors looking to understand this sector better. We're focusing on what drives their performance and, importantly, their potential for returns.
Exactly. We'll break down the numbers, the strategy, give you a solid overview of their financial health and what the future might hold, particularly from an investment perspective.
Okay, so here's the plan for today. First up, key financial highlights from their recent performance. Then we'll really focus in on their dividend policy. It's quite interesting, and what that means for payouts.
Crucial for income investors.
Definitely. After that, we'll look at their operations, how efficient they are, how they're growing. We'll also touch on their sustainability side, ESG stuff.
Good.
And finally, we'll wrap up with their overall financial stability and the outlook. Sound good?
Sounds like a solid roadmap. For anyone investing, hitting these points is, well, essential for figuring out Parkin's value.
Right, let's jump straight into those financials then. So for the full year 2024, Parkin pulled in total revenue of AED 925.2 million.
Wow. Okay. And how does that stack up against the previous year?
It's a pretty big jump, actually. A 19% increase compared to the AED 780.0 million they made in 2023. That kind of growth, it says something.
It really does. 19% is strong. But where exactly is that growth coming from? Breaking down the segments usually gives a clearer picture. Right?
Absolutely. So their main public parking revenue, the on-street stuff most people think of, that was up 13% year on year.
Okay. Healthy.
Developer parking did even better, up 19%. But interestingly, revenue from their multi-story car parks actually went down, fell by 31%.
That is interesting. Any thoughts on why? Maybe shifts in parking habits?
Could be. Or maybe specific locations. The report doesn't deep dive into the why there, but it's something to watch. On the flip side, permits and seasonal cards grew 13%. Okay. And the biggest jump, enforcement fines. That revenue was up a hefty 27%. Other bits and pieces of revenue were up 21% too.
Right, so mostly strong growth, but that multi-story dip is definitely a point investors might want to track. And the big jump in fines, likely tied to better enforcement tech, maybe.
We'll definitely get to the tech side later. I think you're right. Now let's talk profit. Net profit for 2024 hit AED 423.5 million.
And how does that compare?
That's a 7.5% increase from the AED 394.1 million in 2023.
Okay, so profit growing, but maybe not quite as fast as revenue.
Well, consider this. Their Q4 2024 net profit was AED 120 million, up 13% from Q4 2023. And that's despite the introduction of the new 9% corporate tax in 2024.
Okay, that's a key point. Seeing profit growth even after factoring in a new tax. What was the tax impact, roughly?
The corporate tax hit for 2024 was about AED 42.6 million. So yeah, growing through that shows some resilience.
Definitely. For investors, that resilience is a good sign. A corporate tax, just to clarify for everyone, is basically a tax on the company's profits. It directly reduces the net profit, the bottom line. So growing despite it is, well, impressive.
Exactly. Let's also look at EBITDA earnings before interest, taxes, depreciation, and amortization. Think of it as a measure of core operational profitability, how much cash the main business is generating.
Right, before financing costs and accounting adjustments.
For 2024, their EBITDA was AED 583.3 million. And looking just at Q1 2024, it was AED 138.3 million, a really strong 33% jump from Q1 2023.
33%, that's significant. What about the margin?
That's the impressive part. EBITDA margin in Q1 2024 was 64%. That's way up from 52% in Q1 2023.
Wow, a 64% EBITDA margin is very high. That basically means for every dirham of revenue, 64 fils are dropping down to operational profit before those other costs. It suggests they got much better at controlling their operating expenses relative to income. That's a key efficiency metric for investors.
For sure. And just to reiterate, that 9% corporate tax of AED 42.6 million in 2024 does eat into the final net profit available to shareholders.
Makes sense. How about earnings per share, EPS? That's the profit attributable to each individual share.
EPS for 2024 came in at 14.0 fils. It's up from 13.1 fils in 2023.
Okay, so profit per share is also heading in the right direction. Investors generally like to see that rising.
Now, what's driving these numbers operationally? Well, the average hourly public parking tariff stayed pretty much flat, around AED 2.01.
So they didn't just hike prices across the board.
No, but what did change was the average public parking utilization rate. It increased to 26.6% for the full year 2024, up from 24.3% in 2023, and it was even higher in Q4 at 28.3%.
Ah, so the parking spots were fuller, more occupied on average. That utilization rate is key. It tells you how effectively they're using their assets. Higher utilization at a stable price point directly boosts revenue,
Exactly, more people are parking in their spots.
which signals growing demand in their operating areas.
And you see that reflected in the total number of transactions, too. It jumped to 132.2 million in 2024, from about 119 million the year before. Q4 alone saw a 16% increase in transactions.
Okay, so wrapping up the financial highlights for investors, we're seeing strong revenue growth, improving operational profitability shown by that rising EBITDA margin, resilient net profit despite new taxes, and clear signs of growing demand through higher utilization and transaction volumes.
Yeah, it sets a pretty positive stage for discussing something I know a lot of investors are keen on: dividends.
Absolutely. Especially with a business like parking, which can be seen as quite stable. Dividends are often a major draw, and Parkin's policy is, well, quite eye-catching.
It really is. There's stated policies to pay out the hire of two things: either 100% of their net profit for the year or their free cash flow to equity, of course subject to legal reserve requirements.
That's quite a commitment. It signals a very strong focus on returning cash to shareholders. Let's quickly break down free cash flow to equity, or FCFE. Think of it like this. After a company covers all its operating costs and invests whatever it needs to maintain and grow the business, buying new equipment, things like that, the cash that's theoretically left over and could be given to shareholders, that's the free cash flow to equity.
So Parkin is saying they'll give shareholders at least all their accounting profit and potentially more if this free cash flow calculation is higher.
Exactly. It's a very shareholder-friendly stance. How did that play out in 2024?
Well, they paid an interim dividend back in October 2024. That was AED 198.8 million, about 6.63 fills per share for the first half results.
Okay.
And now they're proposing a final dividend for the second half. This still needs shareholder approval in April 2025, mind you. But the proposal is for AED 280.9 million,
Which works out to.
about 9.36 fills per share.
So add the interim and the proposed final.
You get a total expected dividend for the full year 2024 of AED 479.7 million. That's roughly 16.08 fills per share.
And the crucial link, how does that total dividend compare to their net profit for the year?
It's exactly 100% of their reported net profit of ATD 423.5 million. Wait, let me check that calculation. Sorry, the press release states the total dividend of AED 479.7 M is 113% of the net profit for the year. My mistake earlier. So they are indeed distributing more than the net profit, likely reflecting that free cash flow to equity figure being higher.
Okay, that makes the policy even more tangible. Distributing 113% of net profit for FY24 really demonstrates that commitment to paying out based on available cash flow, not just accounting profit. That's a very strong signal to income-focused investors.
Absolutely. And looking forward, the big question for investors is sustainability. Can they keep this up? The report suggests they expect strong, steady cash flow and continued earnings growth.
Which is what you need to underpin those kinds of payouts.
Well,
Future profitability and cash generation are directly tied to maintaining and hopefully growing those dividends over time.
so Parkin seems to be positioning themselves as a potentially strong dividend payer, backed by that policy and recent performance.
Definitely something for income investors to analyze closely. Now, how are they actually achieving the growth and efficiency needed to support all this? Let's look at operations.
Right. A key factor is simply having more places to park. They increased their footprint significantly. By the end of 2024, they're operating around 206,400 paid spaces,
Up from what figure?
up from 196,000 at the end of 2023, so a net addition of over 10,000 spaces.
Okay, and how did those break down?
They added about 8,900 public parking spaces and 8,500 developer spaces on a gross basis. So clear expansion in both core areas.
Expanding the number of spaces is the most direct way to grow potential revenue, assuming demand is there.
And they're not just relying on organic growth. They also started managing parking at two big Majid Al Futtaim malls from January 2025. Those spaces aren't even in the 206,400 count.
Ah, so striking deals with major developers and businesses. That's a smart way to expand into high-traffic areas quickly. It leverages existing locations.
Exactly. And this ties into how they're using technology. They seem to be leaning heavily on tech for efficiency and enforcement. For instance, their fleet of smart scan cars.
The ones that automatically read license plates.
Yeah. They expanded that fleet to 25 vehicles by the end of 2024. They use their own software for tracking, scanning, and issuing fines.
That kind of automation must make enforcement much more efficient than just having inspectors walking around. You can cover more ground more accurately, probably boost compliance and fine revenue.
It seems like it. They also gave their field inspectors handheld devices loaded with AI software. The idea is faster inspections, fewer errors.
Makes sense. Using tech to optimize the human element too? Did they report any impact from this?
They did. They saw a huge 44% increase in the number of license plates scanned in 2024 compared to 2023, up to nearly 25 million plates. They say this has led to better compliance.
44% more scans is massive. That improved enforcement likely contributes to that 27% jump in fine revenue we saw earlier.
Very likely. Tech is also boosting other areas. Seasonal subscriptions and permits were up 36% in 2024, apparently driven by a big rise in short-term cards, suggesting digital options are popular.
Convenience factor. People like managing things easily.
And speaking of fines again, while the number issued went up 33% to 1.67 million, their collection rate was quite high at 86%.
86% collection is pretty good for fines. Shows their processes are effective there too.
Looking ahead on the tech front, they launched a new Parkin mobile app in January 2025.
What does that do?
Right now, it lets customers manage parking services, but they plan to add things like EV charging payments and maybe even car washing services through the app by the end of 2025.
Okay, so moving beyond just parking management, trying to become more of a mobility service platform that could open up new revenue streams and increase customer stickiness.
That seems to be the idea. And underpinning all this tech and partnership-driven growth is what they call a CAPEX light model.
CAPEX light meaning low capital expenditure. They don't need to spend huge amounts on building physical assets.
Exactly. By focusing on technology, managing existing developer spaces, and using things like the scanned cars effectively, they can grow revenue without necessarily building lots of expensive new multi-story car parks, for example.
That's attractive for investors. A CapEx light model generally means more of the cash generated stays in the business or can be returned to shareholders rather than being constantly reinvested into heavy physical infrastructure. It helps boost that free cash flow we talked about.
Makes sense. Now, shifting gears slightly, ESG, environmental, social, and governance, is increasingly on investors' radars. How is Parkin addressing this?
They seem quite active. They state a commitment to the UAE's 2050 net zero goal.
What are they actually doing, though?
Initiatives mentioned include reducing greenhouse gas emissions, improving energy efficiency, maybe using renewable energy. They point to smart infrastructure, expanding EV charging points.
Okay, practical steps.
Also, energy-efficient office designs using solar-powered parking meters. They even mention looking into smart lighting and AI for energy management. Plus, they've done an ESG assessment and are tracking emissions, working towards ISO certifications for environment and safety.
Seems comprehensive on the E. What about the at social?
On the social side, they highlight things like free parking permits for people of determination, senior emeritus, and others. That's about accessibility and social inclusion.
Right.
They also talk about employee welfare, diversity, and emeritization, reporting that 71% of senior management and 33% of the total workforce are emeritus.
That's quite a high percentage, especially in senior management.
Yes, and they mention zero tolerance for unethical behavior, commitment to labor rights, and importantly, zero customer data breaches or losses in 2024.
That data security point is crucial these days.
Absolutely. So overall, these ESG efforts aren't just nice to haves. They can build reputation, manage risks, and appeal to a growing pool of ESG-conscious investors.
Okay, finally, let's zoom out and look at the overall financial health and the future outlook. What are their big strategic goals?
For the next 5 years, they list things you'd expect. Maximize growth, operational excellence, technology innovation, great customer experience, and a continued focus on safety and sustainability.
Pretty standard corporate goals, but the foundation is important.
No.
What about that RTA agreement?
Ah, yes. The concession agreement with the Roads and Transport Authority, that's fundamental. It kicked in January 1st, 2024, and runs for 49 years.
49 years. That's a long time.
It is. It basically grants Parkin the exclusive rights to operate, manage, and charge for public parking across Dubai for that period. It did involve a significant upfront payment to the RTA, plus some deferred payments.
So what does that long-term agreement mean for investors?
It provides a high degree of visibility and stability regarding their core operating rights in Dubai. That kind of long-term contract is generally seen as a major positive, reducing uncertainty.
How do they finance that upfront payment?
They secured AED 1.2 billion in credit facilities from Emirates NBD. That includes a 1.1 billion term loan and a 100 million revolving credit facility. It's unsecured, and the interest rate floats based on EBOR plus a margin.
Okay, so they took on debt. What was their net debt position at the end of 2024?
Net debt stood at AED 725.5 million. Just to clarify, net debt is total debt minus the company's cash and cash equivalents. It gives a picture of their overall indebtedness. And they mention having a robust framework for managing financial risks like credit risk, mainly related to collecting fines, and liquidity risk, ensuring they have cash available when needed.
Did the auditors flag anything specific?
The independent auditor's report highlighted two key audit matters: how Parkin estimates potential losses on unpaid fines, expected credit losses, and how they recognize the revenue from fines. This doesn't mean anything is wrong, but it shows these are complex and significant areas in their financial statements that required special audit attention.
Understandable given how large the fine revenue stream is. Looking beyond Dubai, what's next?
They explicitly mention exploring partnership and expansion opportunities across the wider GCC region, including Saudi Arabia. They believe their expertise and technology platform can be leveraged elsewhere.
Interesting. So potentially exporting the model.
Seems to be part of the long-term vision. Leverage technology, form partnerships, create a seamless parking experience, support Dubai's growth, but also potentially expand geographically, all while delivering shareholder value.
Okay, so wrapping this all up, we've seen a company with strong recent financial growth, particularly in revenue and operational profit.
Yeah, and a very notable, potentially high payout dividend policy that they actually delivered on in 2024, distributing more than their net profit.
Driven by operational improvements, significant technology adoption, boosting efficiency and
The
enforcement.
CapEx light model that helps cash flow, clear ESG commitments, and that very important long-term concession agreement providing stability in their home market.
Plus, ambitions for regional expansion. So, for investors, retail or institutional, looking at this space, Parkin seems to present, well, a fairly compelling case study within Dubai's growing economy.
It does. Which brings us to a final thought for you, the listener. Given Parkin's dominant position in Dubai, secured by that long RTA contract and their increasing use of technology, how well positioned are they really to capitalize on Dubai's smart city evolution? And thinking beyond just parking, what other adjacent services could a company like Parkin potentially integrate or partner on to leverage their infrastructure and customer base, further boosting value and those dividend prospects? Something to mull over.
Definitely food for thought. Thanks for taking this deep dive into Parkin with us.